I'm really excited to offer this webinar as part of our Resiliency in Times of Change series. My name is Elizabeth Noble, and I'm the Manager of Donor Engagement at Sierra Club BC, and I'm speaking to you from beautiful Lekwungen territory in Victoria, BC on Vancouver Island. I'll wait a few minutes while everyone arrives, because I can see that more people are joining. We'll begin with some housekeeping. So just a point of note that we will be recording this webinar, so if you have to drop off, we will email you a link to the recording so you can watch it later, and please feel free to share what you hear today with your networks. If you'd like to open up the chat box, please go ahead and do that now, and you can introduce yourself to the group. Just make sure that you select all panelists and attendees, otherwise you'll just be sending your messages to the panelists. So please go ahead, open up the chat box, let us know who you are, where you're joining us from today, and perhaps the name of the territory that you're calling in from, if you know that. If you have questions for the panelists today that you'd specifically like for them to address, please don't use the chat box. There's often too much chat that's happening, and so instead use the Q&A panel if you have questions that you would like our panelists to respond to. So that would be ideal. Yeah, so let's get started with some introductions here. Guess I could have shared that slide already. So I am delighted to be joined today by 4 guest speakers. First, we have Michael Higgins and Frank Arnold, who are joining us from Generational Wealth Management Group at Raymond James. For over 25 years, the Generational Wealth Management Group has worked with individuals, families, and institutions to preserve and grow their wealth in a prudent and responsible manner. We take a comprehensive approach to wealth management, one that is responsive to clients' needs and reflects their beliefs and ethics. And Sierra Club BC has been working with Frank and Michael for a long time, and they've been really generous in handling any donations of stock that are transferred to us. So they've helped many of our donors divest from fossil fuel companies and transform that money to be used for its highest purpose for the greater good of our planet and future generations. Michael has been a financial advisor at Raymond James since 2002. He works with individuals and families across Canada to incorporate environmental, social, and governance criteria into their investment decision-making and retirement planning. Mike lives in Fairfield with his wife, Louise, and their 2 dogs, Porter and Poppy. In his spare time, you'll find him cycling, working in the garden, or at the curling rink. So hello, Mike.
Hi, thank you for having me.
And Frank studied math and environmental studies at the University of Victoria and has been an investment advisor focusing on environmentally responsible investing for over 20 years. He sits on 2 nonprofit boards and helps out many other charities, primarily by facilitating donations of securities from donors pro bono. Hi, Frank.
Hey there.
Next, we're joined by Caroline, Dean of Horn Coupar Law. Caroline's practice focuses on assisting clients with corporate, trusts, and estate planning needs with an emphasis on taxation. She moved to Vancouver Island with her family in 2012 and recently took some time to work for the BC provincial government as a senior income tax analyst. Caroline believes in a community that meets people where they are at and pitches in to help when needed. Prior to moving to Victoria, Caroline was an active member and a director of the United Way Central and Northern Vancouver Island. Sierra Club BC also has a long-standing relationship with Horn Coupar, which was one of the first law firms in BC to become members of 1% of the Planet. So the firm donates, you guessed it, 1% of their profits to environmental charities, including Sierra Club BC. Thanks, Caroline, for joining us today.
Thank you. Nice to be here.
And then we are also joined by phone by Sierra Club BC's treasurer, Gordon Stewart. Gordon has lived in the Lower Mainland all his life, except for a 6-month stay in Victoria when he was a legislative intern. He lives in South Surrey with his wife, Janelle. They have 3 grown children and 1 granddaughter, Lachlan. Gordon is a graduate of Simon Fraser University. His career has included sport and recreation administration, private sector marketing, and 20+ years in fundraising roles with SFU, Ducks Unlimited Canada, Royal Columbian Hospital Foundation, and the BC Cancer Foundation. We're really fortunate to have his experience on the board, and he'll be talking to us today about planning your legacy as an environmentalist. Welcome, Gordon.
Good afternoon, Elizabeth.
Great. So before we get into the vegetarian meat of this webinar, let's talk about money. So have you ever stopped to think, what is money and why are we so hung up about it? This is a quote from Deepak Chopra. Money is life energy that we exchange and use as a result of the service we provide to the universe. So let's talk about some of the oldest forms of money. Domestic animals are one of the oldest confirmed forms of money. So cattle as money dates back to at least 9,000 BC. And this early Egyptian scene shows cows being traded. Cattle were a common but cumbersome barter item for millennia. And I found a picture of the world's oldest existing coin here, which is from about 600 BCE from the Kingdom of Lydia in modern-day Western Turkey. The copper shield was an object of wealth and prestige among Northwest Coast First Nations and people, particularly the Haida and the Kwakwaka'wakw. It was brought out to display during potlatch and represented more than just the value of the copper. Similarly, in the northeast of Turtle Island, the wampum belt was also used. And I also just want to be really clear, I know these are not, exact literal translations. Both the copper shields and the wampum belts were used to record history, and there's additional meaning behind them than just a simple form of currency. The point is that we've, as humans, used objects that symbolized more than the actual value of those objects, and we've used them as a form of exchange. The first paper money was invented in the New World, quote unquote, in what is now Canada in 1685. Colonial authorities in New France found themselves short of French coins to pay soldiers, so they invented paper money by writing on the back of playing cards, and the signatures on the back of the card gave it validity as currency. And here's some money trivia. Parker Brothers has printed more money for Monopoly games than the Federal Reserve has issued in real money in the United States. And only 8% of the world's currency is actual physical money, and no, the rest isn't Bitcoin. It's just that the majority of transactions are all done digitally, so no physical currency exchanges hands today. So coming back to this, what is money? It's simply a convenient way to transfer energy among humans. It's a means of exchange. Money is basically a symbol of time and energy that we use to exchange. It's a symbol of reciprocity and cooperation. So contrary to many people's thinking, money isn't some evil thing. It's literally one of the greatest examples of human society's desire to collaborate and have a common understanding around value. And so the value of money, humans assign money its value by common agreement, but it has no intrinsic value. The value is only created when the money is exchanged so that energy can flow. Asking about money or talking about money is our society's last taboo, and we have falsely learned to associate money with our intrinsic value as a person. And this is demeaning and causes much suffering, and this false belief contributes to systemic racial and gender-based inequality. But we can choose to let that notion go and to take back the power. So, taming money. When money is taboo, it means only those willing to learn about it can control it. By keeping money as a mysterious and tantalizing commodity, we give it power. And as environmentalists, our job is to depower money and put it in its proper place in our thinking. It's just a tool for transferring energy, and we can put our energy into things that are good for our communities, our families, and of course, for the environment. So I'm going to stop sharing my screen now, and I would like to turn it over. I think, Mike, you're going to go first.
Actually, it's Frank that goes.
Me first, actually.
Oh, I apologize, Frank.
Great. I will carry on from there. But actually, it's a great way to sort of conceptualize it, though, Elizabeth. One of the things that I haven't seen this in a while, but I used to see it all the time, where there was this conception of the economy and the environment were these sort of two separate things, and were sort of interchangeable, as opposed to the economy being a wholly owned subsidiary of the environment, basically. So thank you for that. I'll just bring my slides up. So I want to talk about where are we now, and how did we get here, and what should we do about it? I've got a few points to talk about. So yeah, what's the situation right now with the economy? And as I said, with the economy, it means a different thing to different people. For me in the financial world, it encompasses things like interest rates and stock market and the housing market and mortgage rates and and exchange rates and of course unemployment and the total production of like sort of the GDP and all these sorts of technical measures. But typically for most people, they want to know is how is my business doing if a person's a business owner, and what's the job market like? Is my job safe? And of course, right now there's a lot of uncertainty about that because we've just gone through, I would say, two, and in Canada here, a third sort of shock to the economy, primarily in terms of what's hit the job market. In Canada, in the months of March and April, we lost 3 million jobs in those 2 months. And that was all primarily what I would sort of view in this conceptual graph here as being the lockdown caused unemployment. But now we're in a recession, and we've started a recession. And even though technically the recession might end, and when I say technically, I mean recession is viewed as when GDP is going negative. So we may actually see GDP start to slowly rise, such as the job recovery we had a little bit of in May, but it's going to feel like a recession for quite a long time, and spending will be down, and jobs will not exactly be plentiful for quite a long time here. So that's sort of that second blue chunk of the graph there. That I would say that it really is the now we're in a more traditional recession, and so we're going to see I think continued strains on the economy, continued strains on the job market for the next year at least. I would say probably stretching beyond that as well. Canada has sort of a third little spike here in that graph, in the sense that concurrent with the job losses we saw just due to the coronavirus, and then also with the slowdown in the economy, because of that, oil consumption, energy consumption in general was just down dramatically starting in late February and carrying on now. So as a result, oil prices, which were in the sort of $60 range beforehand, they actually technically went negative for a little bit back in April, but even not negative, they fell dramatically. And this is Western Canadian Select, so this is sort of the basket of Canadian oils, typically a bit of a heavier blend. When you see oil prices reported on the news, it'll be typically it's WTI, which is West Texas Intermediate. It's a little bit more expensive, a little bit lighter grade of oil. Anyways, oil was in the sort of $60 range beforehand. It came all the way down to zero. Now it's back in the 30s, so it's definitely recovered a bit. But in the 30s, a tar sands project is not economic. So and even new conventional well drilling or fracking is all going to get is all going to come to a standstill too. So as a result, you've seen Canada's unemployment, which as of last count was just shy of 14%, is actually closer to 16% in Alberta. And then we've only just seen the first little bit of this sort of oil shock. And yeah, so that's sort of where the economy is in general. Of course, not all economies are hit the same. Not all parts of the economy are hit the same way. Some sectors, obviously, such as online shopping, online restaurant orders and whatnot, DoorDash, Amazon, they've actually done quite well. Whereas other areas like airlines and hotels and other sectors have just been hit really hard. Unfortunately, it's typically the younger folks that are in jobs that are more vulnerable. It's typically lower income folks that are hit harder. It's blue collar jobs that are hit harder, and service industry jobs. Whereas the more more desk jobs and government jobs have of course been a little more safer in this environment. So I want to kind of get into what's it going to feel like when we actually kind of come through recovery? Because ultimately we're not going to actually have a recovery from this until we get a vaccine. And of course, right now there are dozens of candidates that are being tested right now, but we're not going to be seeing a vaccine that actually is going to start to be distributed among the population for hopefully a year from now. But even that would be dramatically faster than we've ever seen vaccines in the past. I'm pretty confident that we are going to see a vaccine. I'm pretty confident that we are going to solve this, but it's just going to take a long time. And I say I'm confident that we're going to solve this because there's just so much scientific resources being devoted towards this in terms of all the different teams around the world that are working on this in conjunction. But it's going to feel, like I say, we're only 3 months into this now in terms of working from home and distancing and various things being in various levels of shutdown. So if this was a hockey analogy, I would say we're only in the first period, with the caveat that this is no ordinary hockey game. This is like the April 2007 Stanley Cup Finals of Dallas versus Vancouver, and it went into 4 overtimes. So it's going to feel kind of like that. As we stretch into 2021, it's going to feel everyone's going to be just really ready for this to end. And now, of course, in this case, the good guys won, and I do think that we are going to solve this, but it's going to be quite a while, and it's going to feel like it. The one thing that everyone always asks me though is why is it the stock market as you can see here, that's the black line. It fell off a cliff as one would expect as the economy comes into a complete shutdown in February, March, and then it's rallied back to the point where in Canada we're only down about 10% as of today. The U.S. is only down about 5% as of today. And if you look at the NASDAQ, which is the NASDAQ is the technology market, it's actually positive year to date. So this doesn't seem to make sense when you've got unemployment that is probably heading towards levels we haven't seen since the Great Depression, when you've got the economy stuck in second gear. So the big question is, why would this be the case? And there are a few reasons. One of them is just that interest rates, of course, have been slashed. So central banks around the world have slashed interest rates dramatically, down to 0 here in Canada, down to 0 in the US, further into negative territory in Europe. And that makes bond prices more expensive. That makes stocks relatively attractive, based on that. Also, it allows companies to borrow money at lower rates, which of course is good for their bottom line as well, even with a reduced demand for their products. The second thing is that I would say central banks of the world and governments of the world, they really learned a lot from the financial crisis that we had 12 years ago. That was in many ways kind of a warm-up. I remember the U.S. the new government under Barack Obama had to fight tooth and nail to get a $900 billion stimulus package passed just 11 years ago. And that's kind of a drop in the bucket compared to what governments around the world are doing right now. The U.S. just passed a $3 trillion surplus, and that's only round 2. They're probably looking at round 3 and 4 as well. Governments around the world are dumping a ton of money. So, but more importantly, as far as the stock market is concerned, is actually the fire hose of liquidity that's been unleashed by the central banks to really prop up the bond market. Because if the bond market is not liquid, then a lot of other things kind of grind to a halt. Because the world does kind of run on credit, basically, in terms of governments and corporations and individuals. If companies can't roll over their bonds and borrow, or if the mortgage market is frozen up, then of course housing grinds to a halt and banks stop lending money. Everything kind of quickly, as they discovered 12 years ago, quickly kind of grinds to a halt. So the central banks of the world quickly injected a lot of liquidity into the market, which has also led to a rally in bond prices and led to a rally in stock prices, as you can see here. That being said, I mean, we also know that the economy and the stock market are two separate things, but they're not that separate. I mean, they're separate in the sense that stock market looks at where the economy is going to go, not where it has been. It looks at where the where the relative attractiveness of these companies are relative to other alternatives like gold, like real estate, like bonds. And when rates are low and bonds are paying very little, then stocks, of course, are relatively more attractive. And there's a bit of a disconnect there with the economy and stocks because of that. The second, but on the other hand, though, I mean, ultimately the economy is just the sum total of all the goods and services that we as a society produce, and or trade, basically. And so if we're all producing and consuming less goods and services, then the economy has shrunk because of it. There is sort of less for companies to be buying and selling, basically. So as a result, I mean, there is definitely a link between the economy and the stock market. It's just that it's not a direct correlation. That being said, the stock market has come up quite a lot, and we think it's been kind of overdone because we think that the other factor of the reason why it's gone up as much as it has is largely because, at least partly because of the reopenings that have all been telegraphed primarily across the U.S. And of course now, if you turn on the news, you see what's happened, which is that clearly they were far too early and ahead of themselves in terms of reopening. And so we think that this rally has kind of come a bit too far, too fast. So I'd be a bit cautious on that, is what we're saying. So we're definitely not diving right in here. Now, what other factors are playing a part in the coronavirus, or beyond coronavirus in the economy? A lot of the same trends that we saw in the last 10 years, the last 20 years even, they haven't really changed. I mean, renewable energy, primarily wind and solar, they are getting increasingly more cost competitive. Coal is increasingly becoming phased out, and this is the U.S. I chose the U.S. because we're now 3 years into the Trump administration, and he ran on bringing back coal, and yet, as you can see here, 3 years into his presidency, there are a lot of coal-fired power plants being shut down across the U.S. That is, I often say, I mean, like, Obama didn't kill coal. I mean, he definitely put in place clean air standards that were far stronger than under the Bush administration and far stronger than under the current administration. But ultimately, it wasn't those rules that killed coal. It was just the steady march of technological progress that has made renewables that much cheaper. If you look at solar now, in many places, not just Arizona, but in many places in the U.S., it's cost competitive for a greenfield new solar plant to be put in place as a new coal-fired plant. Wind, of course, in many parts of the country is far cheaper. So there's been a lot of progress in all that. So as I'm saying, I mean, it's not just, we don't just worry about the coronavirus and the effects on the economy, because a lot of these trends that were in place beforehand, digitization, robotics and whatnot, a lot of which Mike will get into, they were in place beforehand, and they're going to march right along. And I bring up this graph here to show that renewables are starting to, starting to take over as well. So what should investors do during these times. And I think, I mean, in many ways, we would sort of stick to the basics. What can I say? The fundamentals haven't really changed. I mean, we stick to balanced portfolios, so we don't want to get clients into all invested in stocks and take on too much risk. A balanced mix of stocks and bonds. Pick companies that treat their employees well, that are not subject to lawsuits and boycotts, and that don't have a lot of civil liability in terms of government action or in terms of class action lawsuits. Basically, what that means is look at the things like the environmental and social and governance factors of your investments, and because increasingly those are being shown to actually have a not just a feel good effect, but actually a direct financial impact. As I said, with COVID here, I think we're going to be in a slowed down economy for quite a while. So we want to make sure that our clients have companies that are higher quality, that don't have too much debt, that are able to survive this, and I think a combination of high quality, both in terms of environment, social, and governance factors, as well as high quality in terms of traditional factors, is how we view it. So with that, I'll pass over to Mike, who will carry on with our themes.
Thank you, Frank. I'm just going to share my screen here. Perfect. Hopefully everyone can see that. And thanks for the update, Frank. So as Frank mentioned, in the short term, the focus for the economy is probably going to be on the easing of the lockdown measures and how quickly the economy starts to pick up from that. But what we kind of also wanted to look at here was some of the sort of structural shifts that we're going to see moving forward, things that go beyond COVID, that aren't just, today's problem. Now, in fairness, a lot of these were not born out of the COVID health crisis. These existed, to some extent before this, and they're kind of things we think have either accelerated or changed slightly. So we're going to address three of them. I mean, there's lots more, but we're going to address three of them that we think are sort of significant and investors need to be mindful of. The first of which is more indebtedness. Few experts are going to disagree that the massive fiscal and monetary response to COVID was necessary. There was a huge economic shock as a result of the economic lockdown, and that was going to mean interest rate cuts, wage subsidies, emergency lending for individuals and businesses, but also municipalities and local governments, just to keep things going, keep things operating. At current count, it's about $8 trillion, according to the IMF, of money that's been sort of thrown into the economy. In Canada, debt to GDP is expected to jump from about 30% to 50%. That's the same sort of expectation for other developed markets in the world. The good news is, the first question most people think of is like, well, how do we pay this back? Can we pay it back? The good news is that with interest rates as low as they are, servicing the debt is manageable. It doesn't mean that there won't be changes moving forward, which I'll get into, but it at the current time, it's necessary. Those deficits will start to fall to some extent as these emergency measures sort of roll off and we move forward, but that may not be as much as what we would normally think of. There certainly was sort of a bad experience with the austerity measures in the Eurozone after the 2008-2009 financial crisis. And there's also sort of an increased demand for social services, things like universal basic income, things that maybe even 6 months ago were kind of dismissed, now have suddenly become something where we may see some continuation of some of these policies. So these sort of budget deficits may not drop as quickly as historically they have. So we're in a world full of debt, and at least in public service debt. So what does that probably mean? I think the first thing it means is that interest rates are likely to stay low for longer than most people think. And the Federal Reserve Bank in San Francisco did a study, looked at previous pandemics and sort of said, okay, well, what happened in these previous pandemics to interest rates after this happened. And what you can see in this chart is that interest rates for fairly prolonged periods of time after these recessions were lower than what they came into those periods at. The other thing that tends to happen is when we go through a scenario like this is that while the public sector is increasing their debt load, firms and individuals will start to do the exact opposite. People are going to try to rebuild some of that lost wealth. They're in a position where they say, you know, I didn't like that I didn't have a nest egg last time. So if you look at previous recessions that we've had, you start to see these people retrench a little bit and they say, look, I want to have more safety. And because of that, we're going to start to save. What that also does, though, more dollars chasing safe investments means your interest rates stay lower. The last part of this is that central banks are going to be really wary to raise rates. They're going to want to see the economy starting to improve substantially before they start to raise rates. Federal Reserve came out the other day and said they're planning to keep rates at or near zero through 2022. We're in this world of low interest rates for longer, and that's going to have an impact for investors. The other thing that the higher level of indebtedness is going to mean is likely we see slower growth and higher taxes moving forward. Growth, you know, any debt that we take on today has to be paid out of future dollars. Future dollars that could have been spent on investment, could have been spent on social programs, other things are going to have to spend on that debt. So it probably means that we have slower growth moving forward. The other part of this is we have to pay for it. And how are we going to likely pay for it? It's going to come in the form of higher taxes. So I think this is good. There'll be some rollbacks of some of the tax cuts that we saw in the US. We'll probably see an increased focus on sort of global companies that derive their income from all over the globe being taxed in the jurisdictions maybe where they're earning that income, which seems like a more fair way of looking at things. And then you're probably going to see higher tax on the wealthy. So whether that's through capital gains tax or inheritance tax, there's probably going to be a bit of a shift because we're going to have to pay for this indebtedness some way. So as an investor, what does that sort of mean to you? Well, be prepared for more volatility. You know, there's sometimes this confusion between what risk and volatility are. Risk is permanently losing your money. Volatility is what we have to accept day to day when the markets fluctuate. And there's a really interesting study done by the Wall Street Journal, and they looked at sort of pension funds and trying to earn a set rate of return over different time periods. So went back and looked at this a little bit dated, but it looked at 1995. It said if a pension fund wanted to earn 7.5%, it could do that by having 100% of their money in bonds. That was great. We could earn a 7% that we need, and our variation, so if we look at the bottom, there's something called standard deviation, which is how much you vary from that return, is fairly modest at 6%. So we could expect to be plus or minus 6% from that number 2/3 of the time. Fast forward 10 years to 2005, as interest rates are on their steady march downward, and suddenly we can still achieve a 7.5% rate of return, but in order to do that, we're going to have to accept less amount in bonds, which means our volatility goes up, the standard deviation goes up. March forward another 10 years to when interest rates are really low, and you can see it's still achievable to get that return, but we're having to accept about 3 times the volatility. So how do you address that as an investor? And I think the biggest thing here is that you need to have a plan. And you know, the worst thing that happens is you go, I wasn't expecting that to happen. So having a plan that looks at what your needs are. What is your risk tolerance? What are you willing to accept? Because we're probably going to get pushed outside of our comfort zone a little bit and have to accept a little bit more volatility. Doesn't mean you need to take more risk, but you might have to accept more volatility to get the returns you need. We've always been big advocates of having a cash flow plan. So for clients who rely on income out of their portfolio, we look and make sure you have 3 years worth of your income pre-accounted for. So that doesn't mean it's not invested, but it looks at having how much is coming in from your dividends and interest, and then having some set maturities coming up. So we're never in a position where you're forced to sell something and permanently lose money in a time of volatility. The other thing is there's no free lunch. In low interest rate environment, there's a natural tendency over time to start to reach for yield. People will start to look and say, well, that's more than, I could buy that investment and it's higher than a GIC. That comes at a cost. There's always a cost to it, and making sure you understand that that cost is higher risk, better chance of loss. So you want to be just aware of these things as we're kind of moving forward in this low interest rate environment. The next big trend that we sort of see is sort of a less global, more digital world. And these are almost two separate trends, but they overlap in a lot of ways. So COVID has been this experiment in extreme localization. We've all been forced to stay home. And that's forced us to adopt things like Zoom calls, like we're on today, e-commerce, remote learning, working from home, all these things. And we've been forced into it, and we're adopting it at a very quick rate. Yes, as lockdowns ease, these things will wane to some extent, but there are going to be some permanent shifts because of it. And think of companies saying, well, we don't need to do as much travel. Our employees don't need to do as much travel because we can do this via Zoom call. Maybe we can reduce our office space. More people want to be working from home. We might not have as much office space needs moving forward. I can go stay at my parents' house in a small town and get a college education because I'm doing it remotely through e-learning. So all of these things we've been adopted, but there'll be some structural change to. But at the same time, does this sort of continue this shift away from globalization? Have we hit peak globalization? While the digital world makes things easier in some ways, it also is making things much smaller. We've already seen a rise in populism and protectionism, shifts to nationalistic policies, increases of tariffs. COVID-19 has just kind of, hit that home a little harder. Companies are looking at supply chains. Do I really want to rely on a company halfway around the world to supply what I need? Maybe I should be looking at stockpiling inventory or creating that domestically. It's going to have an impact, and it presents risk and it presents opportunity. And I think the risk that we're seeing is that globalization is in retreat for the first time since World War II. And, there's definitely a movement that globalization has not benefited everyone equally. And I think that's a very fair assessment. But the one thing that we must look at and say, it has had a big impact on efficiency. We've seen economies of scale, we've seen foreign direct investment, technological innovation as a result of this, which has led to higher economic growth. If we start to see a decline in globalization, there probably is some lower growth that becomes part of that, lower efficiency. It may be healthy, but it's just in terms of setting expectations for what we're looking at moving forward. It also means that you could have a big divergence in country versus country performance and how one country is doing versus another because of the policies that are in place there. So again, it gets us to we better be prepared to diversify. The big opportunity in this really comes in technology. And technology, I think, for a lot of investors is seen as sort of a risky space, a risky place to be in. And in some ways, they're right. It's rapidly changing. It's very dynamic. What was, this trend has changed into a new trend. But what we're seeing is that these trends that we hadn't really even considered 5 to 10 years ago becoming very important in business and in the economy. KPMG did this study, and they sort of looked at these disruptive technologies, and they got responses from almost 600 companies, and they said, to what extent are these things going to impact the way you interact with customers? And as you can see, almost all of them are companies are thinking these things are significantly going to have an impact. So technology is definitely a space that all investors should be looking at as an opportunity moving forward. Be mindful, make sure you're diversified, that you're not pushing yourself out your risk profile, but it is something that there's an opportunity moving forward in terms of trend. And then the last thing I'm going to talk about for today, and I mean, there are other trends, but is an increased focus on environmental, social, and governance integration into investments. Let's rewind 6 months to the end of 2019. And it was very common for economists and strategists to be out sort of saying, it was the end of a decade, we've got a new decade, what are your big themes for the upcoming decade? And for the first time ever in my career, almost all of them were addressing climate change is one of the key themes they saw in the upcoming decade, which is remarkably refreshing if you're someone like Frank or I who focused on this for a long time. But it was, and it wasn't just, small companies. It was BlackRock and Morgan Stanley and JP Morgan and Bank of America finally realizing that environmental and social problems are real financial risks. So COVID has kind of accelerated that trend in our view, because it was a reminder that these exogenous shocks have a real impact. Climate change will seem like an exogenous shock to the market. And, this movement of saying, maybe companies need to look beyond just simply deepening shareholder pockets and look at what their impact is more broadly has been gaining traction. And we think that's going to continue to accelerate as businesses look to become sustainable long term. So how do we position for this, without, being wild and crazy? Well, the first thing is just make it a priority. Talk to your advisor, educate yourself a little bit about what this means and how to do it. As you can see on the two charts on the right, there's been a huge increase in inflows into investments that are screened for environmental, social, and governance criteria. For years, we battled this sort of myth that, you have to sacrifice performance if you're going to invest in those things. It's, it's pie in the sky, you limit your investment universe. And what we found through COVID is that simply just not true. The first quarter this year, Morningstar Canada did a research, and they looked at the all of the ESG screen funds in Canada, and they found 73% of them outperformed the average. In the US, it was almost identical. It was about 65% of the ESG ETFs in the US outperformed the average. So certainly the myth that you can't make money and invest in companies that are doing a better job of addressing these issues is kind of out the window. So, it's certainly something that investors should be looking at, and I think it's only going to gain in importance. And, within that, don't forget your plan. I'm sounding like I'm harping the same subject matter here, but you have to still invest in line with what your objectives are. You can't go there's sometimes people like to use ESG as a shortcut. I'd like to invest in that company because they're doing great things, but it might not fit with what you really should be owning from a risk and tolerance standpoint. But there are lots of great companies that are screened for ESG. Be diversified. There is going to be a huge reallocation of capital. Frank talked about it with coal-fired power plants earlier. Reallocation of capital happens in sort of waves and different things. So, great technology may not ultimately be the technology winner. So be diversified in what you're investing in, be sensible with what you're buying. And then finally, don't get hung up on the fact that a company has to be perfect. While we'd all like change to progress faster, what we are looking to do is encourage the companies, find those that are leaders, those that are looking beyond next quarter's profits, those that are looking to be good corporate citizens long term, and invest there. The other thing is that as an owner of the company, you've got the strongest voice. The most influential voice within a company is the ownership. So, it's always going to be shades of gray. There might be things about a company that you dislike, but they may be pushing, an agenda forward that is really something that needs to move forward and really positive. So don't get sort of hung up on that. I'm going to stop there. If people are interested, the Responsible Investment Association of Canada has a good website with lots about ESG investing. Corporate Knights website, which I think is just corporateknights.com, is another good place, or feel free to talk to Frank or I about it. But these are trends that we sort of see as moving forward.
That's wonderful. Thank you both so much for providing your insight. Really, really valuable. I'm recognizing that we're cutting it close. We may not have a lot of time for questions at the end, but I know that we will be sharing contact information for all of the panelists. So if we don't get to your questions today, we'll try and make sure that we can connect you with the right person. So Maya, if you can go ahead and unmute Gordon there, I'm going to ask him to have us shift gears back up to a more aspirational level. And Gordon, can you give us your views on legacy planning for environmentalists?
Yeah, I sure can. Thank you, Elizabeth. First of all, from the Board of Directors, I want to say a sincere thank you to everyone who's a part of this webinar. We really appreciate your interest in it and support of Sierra Club BC. I'm going to talk about gifts through people's wills. And there's a fundamental question you would ask yourself in this regard, and that is, why consider Sierra Club of BC or any other organization to be the beneficiary of a gift through your will? When you are considering an organization for this kind of extraordinary gift, you want the following elements to be in place. You'd look for a track record of solid success, indicating that the organization has used previous donations to advance their cause effectively. And certainly in the case of Sierra Club, names like Carmana Valley and Clayoquot Sound, Cypress Mountain Provincial Park, Pacific Spirit Regional Park, Walburn Valley, and so on, are names many of you will be familiar with. You also want to be sure that the work of the organization will not be done for many years. In other words, the organization has a future. And this is why universities and hospitals attract so many gifts through wills. They have a long-term future ahead. You want the organization to be well managed so that you know that the proceeds of your gift will be used effectively. And I can tell you, as a volunteer with Sierra Club on the board and chairing the finance committee, Sierra Club is very transparent and well governed. They, of course, have an annual audit, and again this year had a clean audit declared by KPMG. The organization is in a strong financial situation now, despite COVID. And one of the main reasons is that Sierra Club has received some very significant will bequests in the past couple of years, which have been enormously helpful. Before I say anything more, an important thing to keep in mind, even though a gift through your will can, in the case of a bequest at least, be quite simple, we always urge people to seek professional advice to ensure that your wishes are adhered to and that you receive the maximum potential benefit in the way of tax relief for your generosity. A gift in your will it's a deeply personal kind of thing, a forward-thinking way to give. It often serves as an expression of personal priorities and values that have been developed over a lifetime. If you are like me and fantasize about winning a lottery and then giving money to support causes you believe in, the distribution of your estate upon your death may be about the next best thing. My problem is that I actually rarely buy lottery tickets, so my odds of winning aren't that great. The fact is that almost everyone has more capacity to give upon their death than during their lifetime. So you have the ability to make some of your philanthropic fantasies come true by way of a gift through your will. And as of now, it's about 1.5 million British Columbians have provided for charities through their wills. So it's a popular way to support organizations that you believe in. Once family and friends are cared for, and there is basically an obligation in this province to take care of your heirs, you can enjoy the experience of providing for your favorite charities. And with a well-planned gift, you can reduce or even eliminate your final income taxes. So that's a pretty attractive kind of win-win right there. There are a number of different ways to give through your will. You can give a gift of life insurance with Sierra Club as the named beneficiary. Gifts of money from RRSPs or RIFs or TFSAs. You can provide a gift of shares or stocks. Gifts of real estate or personal property such as art, or the establishing of a charitable gift annuity or charitable remainder trust. Those are all can be very effective ways of giving. However, about 95% or more of charitable gifts through wills are in the form of will bequests. So that's really where Sierra Club focuses. They can be very simple, as I say. It can be as simple as one sentence in your will or in a codicil attached to your will, it's important to remember that a bequest can be changed or revoked at any time. So if your situation changes or if your enthusiasm for a particular organization wanes or increases, you can change your bequest to reflect that. So you are not tied irrevocably to a decision you may make now. The two most common bequests, I'll just mention them briefly, are a residual bequest, where Sierra Club would receive a portion of the remainder of your estate after other specific gifts have been made, and a specific bequest wherein Sierra Club would receive a specific dollar amount or fraction of your estate. I'm going to leave my comments there. I think what I really wanted to get across is that will bequests can be quite simple and a very effective way in which to support charities in which you, or causes in which you believe. Okay, thank you, Elizabeth.
Thanks so much, Gordon. I really appreciate that. So let's go next to Caroline, who can talk to us a bit more specifically about estate planning tools that are available.
Thanks, Elizabeth. I'm just mindful of the time. Do I have till 1 o'clock? Is that?
Yeah, I think we'll go until 1, and then if there's additional questions, we can follow up with others by email.
Perfect, thank you. So thanks for having me today. I love talking about estate planning generally, and going through questions and issues that clients have. It's a lot of fun. For me, not so much fun maybe for clients to talk about, you know, their demise, but it is an interesting area of the law. I'm going to focus and piggyback a bit on what Gordon was saying about charitable bequests. And as he said, I think he said it was 95% of charitable bequests are made very simply. For instance, a very simple charitable bequest would be to give $25,000 to the Sierra Club of BC. So very simple, straightforward, easy to do, easy to change bequest. So what would happen with that bequest is that if the Sierra Club would take that money, put it into their general fund, and use it however they would like or choose to use it within their charitable purposes. What I want to just highlight is that some gifts can go a bit further than that. So you could add conditions or restrictions onto your gift or specific purposes. And I just want to talk about what the effect of that is and some advice about doing that. So let's take that $25,000 gift and we'll add a restriction to it. So $25,000 to the Sierra Club of BC to be used for their education program. By adding that last bit, restricting the purpose to their education program, what you've actually done is set up a charitable purpose trust. Many people don't realize that. And what it does for the charity is it signals to them that they can't put that money into their general fund. They have to account for it separately and make sure that they're using it for the purpose that you've put forward for their education program in this case. I want to take it one step further just to complicate it a bit more and just to provide a little bit of a warning, I guess, when you start adding on restrictions onto charitable gifts. So let's take that $25,000 and say, want to give it to Sierra Club, but the capital must remain intact and the income must be used for the education program. While that's still a wonderful gift and the Sierra Club may very well take that gift, I just want to advise that when you start putting on restrictions like that, a charity can decide and may decide to refuse the gift. The reason being that they might just look at the amount of the money and the administrative costs of monitoring that fund separately and using it for that purpose. The administrative costs might be more than the benefit that they would receive from it. So not to say that Sierra Club would refuse the gift, but charities could do so. So my warning to you is that if you want to set up a gift with specific provisions, specific restrictions on it, that you should run the wording, really run that wording by the charity. It'll give you some comfort. You know, if they say, yep, that's great, we're fine with your wording, then that gives you comfort that your gift will actually follow through to where you want it to go. If they don't like your wording, then you have that chance, that opportunity to work with them to get the wording that they would feel comfortable with, and make, in that way, then that gives you some comfort that your gift is going or will go where you want it to go. Now, I also wanted to raise another method of giving within your will, and this is where, you know, if you know what you want your money to do, you know the purpose that you want your money to go to, but you don't necessarily know which charity you want the money to go to, which charity you want to benefit. You could give your executor the power to make a charitable gift on your behalf to a charity that does environmental work, for instance. You could provide even more guidance to your trustee or your executor if you wanted to do so. What happens then is your executor has that power to take that money, or take however much you set aside for charitable giving, and decide the charity that receives it within the parameters that you've given him or her. If you were to do that, and while that might seem an answer to your question if you're not sure about which charity you want to benefit, there's a very different tax effect by doing it that way. And so I just want to caution that you may still end up doing it that way, but you really want to work with professionals that understand the differences between the two methods of giving to know what the tax effect is and which one would be better suited for your estate planning goal. Another method of giving that Gordon mentioned briefly, and I wanted to talk about a bit, was the charitable remainder trust. And this kind of coincides with my comment about taxation and different ways that your giving can provide taxable benefits to you. So a charitable remainder trust is actually something you set up while you're alive. So the trust is set up while you're alive. The charity actually receives the property, or at least the benefit of the property, but they don't actually receive, they don't receive the benefit until you've passed away. So you retain what's called a life estate in that property. You get the full benefit of it until you pass away. At the date that you die, the charity then gets the benefit and full title to that property. This method of giving works for any type of asset that could provide a benefit. So stocks, investment portfolios, land, really anything that you can think of where you know you want a charity to have this, but you want to continue to benefit from it. You could set up a charitable remainder trust to do that for you. The benefit, the tax benefit to doing that is you do receive credit for the donation, the tax credit while you're alive. So you do get to use that credit in your income while you're still alive. So you get that benefit, not your estate. The other thing that, reason why you might want to consider doing it is if you want to make sure that your gift follows through, that this specific property or asset goes to a charity, and you're concerned about making that gift in your will for some reason or other, by setting it up while you're alive, it's done. The terms of the charitable remainder trust dictate that gift, not your estate, not your will. And so any issues there might be in your estate, this property would not be touched by them. So that's another benefit that some people have in putting these together. If you were to consider doing a charitable remainder trust, obviously tax benefits, there's some really good things to do, really good reasons to do it, but you do want to make sure that you're working with professionals that understand these tools and can help set them up, because if they're not set up properly, you won't get the tax benefit and it could fail. So you do really want to work with someone that understands them and also knows the practical side of it, because obviously you would have to live with this trust for the rest of your life. So you want to know, you want to work with someone that understands that as well. Last, I just wanted to expand on some of those cautions. So any way that you decide to give in your estate plan, you want to make sure that your professionals are guiding you on how that giving fits with your wider estate plan. Because obviously it's got to interconnect and work with everything else. Otherwise it's not, maybe not going to turn out the way that you have planned. So thank you again, Elizabeth.
Thanks, Caroline. We just have one quick question about what would happen with a situation where someone put a restriction in place and the charity refused the gift.
Then the gift would lapse and it would go into residue. So whoever your residual beneficiaries were would get that.
Okay, terrific. Yeah, so Frank, did you have a question for the whole group that you wanted to ask, or was that for something for us later?
Oh, no, I just was a question for you or Gordon. So we've heard about gifts of securities and real estate and life insurance, and I've facilitated lots of donations of securities. Would someone talk to you or to Gordon about gifts of livestock, as you talked about earlier?
That's a really good question. I definitely would need a professional to help guide me on any gifts of livestock. I have no experience directly with that. Okay, great. Well, I'm sorry that we don't have time for questions. We will be sharing all of the contact information of our panelists today, so that if you do have questions that you'd like to ask about your financial planning or your estate plans, we'd like to encourage you to reach out. And I really appreciate all of you taking the time to watch this webinar today. And thank you to all of our panelists. Sierra Club BC, of course, is a registered charity, so all of your donations are tax deductible. And if you're not already a member, I of course encourage you to become one at sierraclub.bc.ca. Thank you so much, everyone, and have a great afternoon.